Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Monday, April 27th, 2020. What we'll do is start out with an overview of the broad markets because that is still one of our official and active trades, so we'll start there and then roll into the other trade ideas. There are not too many right now, so I'll touch on each one real quick. These are the active trade ideas. We have one to update today. Sugar hit our stop, and so I'm going to go through those one at a time. But before I start there, I just want to mention that I did, I sent out that post before the close today. Decided to go ahead. I was teeter-tottering. This market's been resilient lately, but there was enough evidence, I believe, to go ahead and pull that stop one more time on the SPY trade. Part of that is we have the earnings on deck. Now, this can go either way, obviously, but here's what we're looking at tomorrow. Big, like I mentioned this morning, big earnings calendar this week. We have, I think, it's a very good percentage, a quarter or more of the S&P 500 or total stocks reporting this week. Tomorrow, we kick off with 3M, Pepsi, Pfizer, UPS, Caterpillar, D.R. Horton, Merck, Southwest Airlines. That's all in the morning. And of course, it keeps going from there. And then after the market closes, AMD. So this is going to show us where the techs are, or the semis are. Well, not show us, but we'll see where that goes. We already saw what happened with Intel already, and it's kind of Intel's hanging in there. But again, it's been under pressure, came under pressure since earnings. Alphabet. So there's one of our fangs right there, and Starbucks as well, another big component in the S&P 500. That's the other share class for Alphabet. Ford Motor Company, and you can see down the road. So, and it goes on and on. Let me just make clear, if you're not aware, if you're on rightsideofthechart.com, you click on resources up here, which I just did. It's going to bring you into the support center. From there, a lot of good stuff. If you're logged in, you're going to see account settings here, FAQ. But what I go to almost on a daily basis during the week, and especially every morning, I come down here to tools of the trade, and you have an earnings calendar as well as the economic calendar. Right now, being that we're in peak earnings season, I think you should be looking at this at least, glance it throughout the week. If you click that, it's going to open up a link to Earnings Whisper website, and right up here on the top of the page, it should bring you in. The link should bring you into the calendar. If not, you click right there, and when you click on the calendar, it'll bring you to the day you're at. Come up here. For example, right now I want to see what's going on tomorrow, and that's what I just did. We have the ones I just showed you, and it's going to toggle by first BMO before the market opens, and then you want to click this tab AMC after the market closes, which I just did. And what they do, it's nice because they sort those by the importance. In other words, it's not solely by market cap. It's just, popular, liquid, widely held, actively traded stocks are going to appear up top. If you scroll down, then you're going to see more obscure names. But again, it might be something that you're trading. And more importantly, if you have a stock, let's just say it's we'll do KHC. That's one I shared as a potential long trade. I typed in wrong. KHC is Kraft Heinz company, and April 30th. So you can see the date there by searching for any ticker that you're at. Okay, let's jump in and look at the markets real quick. We'll start out with, we're going to go through all the active trades right here. This is the list, but we're going to start with SPY because, again, that's broad market, and maybe you don't have any of the official trades on the site, but you want to, what's going on with the market. Bigger picture is this wedge broke down on SPY, a little kickback rally, but yet on QQQ, this is the comparable uptrend line I went over this morning. So whereas SPY has broken down, the tech-heavy QQQ, which has been the not a beneficiary of the COVID, but it's certainly those companies have held up more because they were less susceptible to the stay-at-home orders and all that kind of good stuff. So there it is on SPY. We drill down the 60-minute chart. Like I said, today we were up a pretty good up move, but it was not impulsive since the gap. You can see we stalled out today, traded mostly sideways, and as I mentioned, and I did an update earlier today, the most important things, the reason that I decided to go ahead one more time, extend that stop, is a lot of this. Everything I'm going to cover right now. The divergences that were in place right here when we broke down that wedge, we've only moved sideways. So again, it's not as if those divergences didn't play out back then. They played out, and I always say this: prices or a stock can correct in one of two ways or a combination thereof. They can correct in price That's a price correction. Let's say we move down T1, hit T2, T3. That's certainly a price correction. Or they can correct in time, and sometimes in both. This is more of it's a pretty tight trading range. Now, if we had gone down here to T1, hit that, moved up, done this, I would say we corrected in both time and price. So far in this case, it's been a correction in price, if you will, because we've moved sideways. SPY, in other words, has stalled out, has not gone any higher, relatively speaking. Don't say, oh, Randy, we're higher than back here on the 14th of April or whatever that was right here when we peaked out. But we're talking fractionally. You can measure it out, do your own measuring tool on your charting program. You're talking today we closed up less than 1% above where we were back on the 14th of April. Today's the 27th, so we're talking 2 weeks ago. And again, we've been in that trading range there. I covered that many times. So because of that, we broke out, took out that high today by ever so slightly, if I zoom in, but it was so unimpulsive. In other words, when you break out above a previous reaction high, like this one right here from the 17th. That was a high of 287.30. Today we went a little bit above that, I think, high 288.27. Right. The opposite of what you want to see. You want to see an impulsive breakout, big green candle, solid close above that level, and additional follow-up. So again, that lackluster follow-through, I am not going to try to chalk that today up to being bearish. We're up 1.43%. So you can only say, look, that's bullish. Market's not only holding up, it's gone on and it's still managed to eke out a pop above that previous high, but then we close back down below it. So take it for what it's worth. To me, where I'm going with this is nothing has changed. We've been trading now for the last 3 weeks altogether in this tight trading range right there. And so we need a solid break above the high end of that range or a solid break below to really get the market going in the next trend here, up or down. And it's because of these divergences that I would put much better than 50% odds that the break is ultimately going to be to the downside, even if we have a little pop up above and minor run up and then a failure because of that. And many other reasons, everything I've talked here for weeks, the long-term charts, the weekly charts, resistance level. The biggest disconnect of fundamentals and technicals that one of the biggest that I've ever seen. During the Great Depression or Great Recession, 2008, 2009, stocks got dirt cheap at the bottom. But again, it was all relative at the time. In hindsight, they were dirt cheap because the banking system never collapsed. The government managed to come in and save the banks. Had the banking system and financial, the credit markets completely seized up, it could have got worse. But again, only hindsight's going to tell you that stuff. But like I said, I maintain what I've been saying for weeks now, and since back here, that the upside potential, I believe, is very limited compared to the downside potential should these technicals and the fundamentals play out. So we'll move on from there. QQQ, same thing. Take away all the lines on this chart. Let's keep it very clean and simple. And what you can see down below is, the divergence. You had that first, the trend line right here. There's a nice clean-up trend line. QQQ is walking up that trend line, very well defined. A wedge. The top of the wedge can go higher or lower. This line is, for lack of a better word, immutable. In other words, that line shouldn't change. We have a lot of reactions on that line so far. That's significant. When I draw divergence lines like this, I'm just highlighting the divergence. It's more so a divergence line than an actual trend line because you only have a couple reactions here. So this one has a lot more reactions. This is our uptrend line, and that's our divergent line. That's why I drew it this way this morning. Look, we could pop up, and it's not going to change the technical posture of the markets unless we go up a lot more than just maybe a couple percentage points here. Because if we do that, we just work our way up within the wedge. And whether or not that happens, this is where a sell signal comes if and when we have a solid break below that trend line. And I think it's well enough watched, meaning so obvious that call technical analysis if you want, a self-fulfilling prophecy, if you will, or whatever's the right word, almost a vicious cycle of selling comes in when traders see this. You have longs that will exit that are riding the trend up on a break of the uptrend line. You have shorts that'll jump in and short it. And of course, that's selling on both sides, and that's where you usually get those quick moves down. So that's it. We're waiting for this. And if this happens, so be it. If it doesn't, if we break down before then, so be it. And if we do much more than that, then guess what happens? No longer have divergences. These indicators go on to take out the previous highs. We're going to start moving through the next overhead resistance level on the major exchanges or the major indexes, and it really sort of dirties up the that near-term case, the longer-term case that can be made that this has just been a bear market rally that we're in, and we're towards the latter end of the stages. And I said this before when we were still on the way down. I said, mark my words, when the first big bear market rally comes, not that little kickback rally here, first big bear market rally, towards the end of it, you are going to want to be long. You're going to want to be bullish. You're going to think that the market's going to continue to go up. That is the nature of a bear market. If you've traded them before, and the last one was back in 2007 to 2009, you'll know what I'm talking about. If you haven't traded a bear market, and the one before that was 2000 to 2002, if you haven't traded one, well, I can't promise you that's what this is, but this is what it usually feels like. And you start having the media and everything spinning it, talking about not a matter of if we're going to new highs, but when we're going to get there and how the rest of the recovery is going to look like. So that's that. And let's move on to the index ETF or the index futures. Talk about that real quick. So one of the reasons that I, among others, that I extended that stop to is that we had the sell signals on the futures today. Not hard sell signals, not what I really wanted to see. Just zoomed out to a longer term view of a 60-minute chart. Let me go back in here and tighten back up and just show you in case you missed the analysis earlier today. So we had these bearish crossover on the PPO. We also put in, since I posted that earlier, a little small divergent high. So what you're looking at here, this is a 60-minute chart of ES, the S&P 500 futures, and you're looking at the first rising wedge pattern we've had there in a while, right there. And there's your divergence that you want to see. Helps to confirm the bearish nature of a rising wedge pattern. And you would just need to see a solid break below that level. And that would also mean a failure here at these around those previous highs right there. And I think I did I do a longer term chart here today, 5 months, 2-hour candles. Here we go. Yeah, I did. Well, you can see it here. Forget about these annotations with the divergent highs. What I was trying to show you earlier today, I think I put this chart up on the home page. Big level right here. That was a big reaction low. Kickback, failed at that level, and now we're back there again. We're back there again. So this is a battleground for bulls and bears. And it's the most well-defined resistance level that we've been at since the lows right here. So like I said, I'd almost put slightly favorable odds that we're going to pop it, as well as NQ, just to do that beautiful stop clearing move. We call it a fake out. If it's much more than that, and this is what sucks about investing and trading, is expecting something like this, staying short, and it continue to go up. But I can tell you, anything much above here, especially on a daily close or depending how it looks, that's where I'll begin to close out short positions. And I like to scale out the same way I scale in with swing trade positions. But as of now, I think we could either fail here or at best get a little quick whipsaw pop above there. And I'm not drawing it to scale, but you guys know what I mean. In other words, we had a slight marginal new high in what was it? SPY today. And then let me find NQ for you. Here's NQ. I went over that earlier today. Again, put these charts up a couple times. We had the, just like ES, a bearish crossover on the PPO, bearish crossover. And you look for these above the zero line, these what I call high-level bearish PPO crossovers. So that PPO will sometimes kiss the lines there and stay, keeping that trend bullish. But it's when you get the bearish crossover and you're looking at the orange line, which is the PPO line, crossing down through that signal line, the white line. And again, you can see those coming there. Even by themselves, they're pretty darn good, standalone sell signals. And the problem is nothing's 100%. So do I sit here? Because if you might look at that and say, oh man, Randy, why don't I just go long every time we have a bullish PPO crossover below the zero line, low level, and short every time we get that? Well, it works, and then one time it does, you get that and you get a little signal and then it goes back up. And that's a possibility. So, like I said, but we also took out the trend line there today. So what could happen if we do pop up tomorrow? Then what you look for is maybe we go up and put in a lower low on the PPO, maybe come in a back test here, put in a divergent high like that, and then go down. So and you came really close on NQ to that previous reaction high, but we haven't gotten there yet. So that would kind of mesh with that, and it meshes with my analysis earlier today, which at best took a minimal upside, 2.5% on NQ, somewhere around there, followed by reversal. That would very much keep the current bearish technical posture solidly intact, meaning the divergences, the wedges, everything else there, overhead resistance that hadn't yet been taken out, or at best maybe a brief fake out, like I said, a temporary break of resistance followed by a reversal, and that's what we call a bear trap or a false breakout. Okay, spend a little more time on the broad markets because that's more complex, if you will, more moving parts. We have the futures and all that other different indexes to look at, but now we get to the trade ideas. It's just it. We'll look at each one. We'll just look at it, the time frame we're trading off of. ADSK, Autodesk. This one's first one up. Going through these just in alphabetical order here. This is where I've moved towards. You probably noticed a change recently, and I've done this in the past, adapting to different market conditions. In this market, I believe that I favor stops based on a daily close above a certain level. That's where on a normal swing trade, my stop would have been, and it was, but I made it instead of intraday on a closing basis. You can see here we hit a high today of 186.56. That would have taken the stop out, but by moving that to a stop on a daily close above that level. If you're new to the site, you're wondering how to do that. Well, it's not a hard thing set in stone, but typically at 10 minutes to the close, if we were, let's say, 1-2% above that level, doubtful you're going to see that faded, especially at 358, 359, if you're well above that level. If you're right around on there, if you're at 3:59 p.m., if you're at 186.20, you might want to hold off. It's up to you. But I'm a stickler for sticking by these. If I don't modify a stop or a price target on a trade beforehand, as far as the official trades go, I'm going to count what it said there. So this one, they missed our stop, and what they did today is they put this little doji stick here. That's a potential topping stick. Don't get too excited about those because they kind of occur even during an uptrend, but where you start to get a little excited about it if you are short or looking to short, a couple things. If we gap down, number one, and close down below there, that would be an island top that leaves one candle alone as an island separated by a gap on both sides. But even if you get just a red candle, even if you don't gap down, you get a solid red candle, that helps confirm this as a potential topping candlestick. And so you could short then, if you're not already short Autodesk, with a stop above the top of that red candle or stop above that recent candle, or just go with the stop on this trade here. That's that. So not much more to talk about. This one has a lot of work to do still for us. Like I said, we just narrowly, well, not narrowly, by the close, we closed solidly back down below that level, but avoided the stop rate on that one today, because that's what I think that was, is a stop rate. I think you're going to see more and more of these little pops, stop clearing moves before these a lot of these stocks start to reverse trend. Berkshire is based off the weekly time frame. We shorted that one at 195.90, and so we're still profitable. Nothing to write home about, because this one we're swinging for the fences. This is a longer term trade. This is what I call a kind of a trend trade, or playing what I believe to be another leg down in the financials. Whether we get it or not, we're up, I don't know, 4%. If you want to take profits because you're worried about the market going up or whatever reason, you can, but I'm maintaining these targets for right now, T1 and T2 right there, and it still looks good. Same basis, same reason we shorted it before. Next one up was Costco. Costco is also based on a weekly close, also a longer term, trend trade. Expecting a major top in this stock here sometime soon, and not much else to be said. It's the maximum stop is right there, and we're still well below that, and need to take out this trend line right here to get some downside traction, and then that T1 level, really the support level, which T1 is set just above. The support's at 282. First target set a little bit above that at 282.20. So really not much to update there. Gold, I've shared my thoughts quite a bit on gold recently. It is in a bull market, a bull trend, has been for quite some time. All the way back here, we're on a weekly chart back to late 2015. That's when it bottomed. That's when this bull started for gold in December 2015. So there are divergences. So the way you take that is, even within a bull market, you get these divergent highs, and they often play out for corrections, as this one already did. Remember, we're looking at a weekly chart, but we already had a divergent high at this point, and we had a correction, sharp correction. In fact, that's where we went long this last time around on gold. That one's based on the daily chart, so let me flip back to that. There it is. All right, so we went in at 139.12 and already hit our second target, made it about almost halfway to the fourth and final target. We hit our third target as well, I should have said. And that's where we're at. So from this perspective, it looks okay, but when I go back here, there's this uptrend line on the daily chart. It was broken, small divergent high. Easiest way for me to say this, guys, if I didn't own gold right now, I would probably sit and hold off at most, maybe scale in, small position, but I don't see a hard buy signal. And I could certainly make the case that gold could correct, have another big leg down if these divergences play out. What would that? It would most likely coincide with an additional rally in the stock market, maybe run somewhere close to, possibly above the old highs. I don't see that as a very likely possibility. It's certainly a possibility. I don't see it as a likely scenario right now, but anything's possible. And if it does, you probably see money come out of gold as a flight to safety, as they exit that flight to safety bid. So what I'd really like to see, again, we're still long. I'm not changing any of the trade parameters, giving this one room, because in a bull market, a lot of times divergences are burned through. They get shrugged off. In other words, security keeps going up and takes out the divergence, and especially after a little correction like that, and goes on. So we'll just leave gold alone right now. Like I said, I've been saying for the last week, I'm cautiously bullish on gold at this point in time. LQD, corporate bonds, remember this is where the Fed came in. They evoked emergency charters to come in and support the credit markets by doing things they're normally not allowed to do, including the direct buying of junk bonds and investment grade bonds. Even this ETF LQD, they were able to go in and buy ETFs as well on that. So now where I'm going with this one is, today I posted an update. We have this gap right here. Now LQD, these are investment grade bonds. Remember the basis for these first two trades. We shorted it here on the first leg down there, sidestepped the kickback rally, and then reshorted it again, and then had our third short trade. Both of those we hit our final target, successfully got out and sidestepped the ensuing rally. This time around we shorted, and that's when the Fed came in, so we were caught short on this one. Modified the stops, stick with it, which is a good thing, because had I stuck with that, I pulled it just that one day that we went above that level. That was the only day I suspended that one, and so far for doing that, we gained back about, it's nothing huge, but again, we weren't, this thing doesn't move as big as the stock market. It's dropped about 2.5% from there. I think it'll go on to backfill that gap right there, that big old gap from the other day. That was a couple weeks back. That's when the Fed announced everything. The run up before that was just insider trading. Those in the know that either suspected or knew outright that what the Fed was going to do, and that's part of that sharp rally leading up there. Now we need to look at junk. JNK, junk bonds, have already backfilled that comparable gap. Remember, this is the Fed's also backstopping the junk bond market as well. There's the big old gap I'm referring to. So you can see JNK, which is one of two big junk bond ETFs, and HYG, they've already done that. So where, what this was is, the Fed's going to, do as much as they can to support these markets, but don't be delusional. They're not going to take them to new all-time highs. They can only do so much. The deeper they dig themselves in other words, the more junk paper they buy, a lot of that's eventually going to blow up. They're giving a lifeline to companies for the time being, just trying to keep the credit market stable, but they're going to take huge losses on this, which will of course be passed on to the taxpayer. And so what I'm trying to say, they don't want to see it getting down here or below again, especially LQD. That more so, the corporate investment grade credit market. So, but I don't think they're going to prevent a gap backfill. I think that's a pretty likely thing. And to see that happen, we just need to get into that gap a little bit more. Once you enter the gap from above, usually you fill it. So there's the bottom of the gap right there, about 126.22. Probably spending more time on this one than I should. Like I said, there's not a lot of downside potential now. I'm leaving it on, and we'll probably end up closing this out either at or before the time T1 is hit. These were the original targets because, again, with the Fed backstop. But I think when we get another meltdown, another leg down the market, that'll most likely bring us down to at least that T1 target. So we'll just leave it alone for now. NVIDIA. NVIDIA is based off the 60-minute time frame. And here's another example of why I'm preferring stops on a daily close. I had that stop at 303.50. If it was any move up to that level, and it's above, so it means it has to close at 303.51 or higher. But we hit a high today right there at 303.50. See, that's a level based on where we shorted at the time, which was objective. Remember, NVIDIA broke down from this bearish rising wedge pattern here, and then I think I waited till a break of the 284.80 to be safe. We got it there, and then impulsive sell. That was a very solid sell signal. I would take that trade over time and time again. When we had a little kickback rally because the market's been holding up. And so where I'm going with this is, I think that was a logical stop, and I think a lot of traders probably had stops in here. In fact, I think that's what this green candle probably did. This was probably a stop clearing run, took out a lot of stops from the shorts that shorted there, and hopefully that'll be the end of it, and then we drift lower, take out this minor trend line, and then this one goes on to play out to hit our first and second and possible third targets. I'll make a decision if and when we get close to T1 or T2 whether or not to extend and add a third target here, depending on what I see. Next one up, PALL, Palladium. Not much to add. Down almost 5% today, which is, Palladium's a choppy little commodity. Where we entered here on a break of below 207. We entered back here. We already hit it, gap below our previous first target, so that's where you would have been filled if you had an order to cover at T1 before. So we already hit our first target on that gap down, and that remains T2 and T3. Nothing much else to say. It looks good right now. Let me look at Palladium futures. That's platinum. Here's Palladium futures. Again, I already mentioned this. We finally took out this trend line on that impulsive move down last week. Boom, there it was. Kick back. Oh no, not that one. Right here. We took out the trend line on this move down last week. Hit that 1773 next target that I had. Perfect kiss almost. Went up, back tested the trend line. That's TA101. You short a breakdown or a back test, and so now we need to take out 1773, and that opens up the door to the next targets like that. Two more to go. This one is SGG. This one I will have to follow up with an update on the home page to move it out. They took out the stop. Stop was under any move under 3065 today, and they took that out there and closed down below it. So even the fact that they took it out intraday took us out of that one. So the story on this one, we entered it here, back here at 3292, right around this level, rallied up, hit our first target for a quick 12, whatever it was, 11, 12, 13%, and then it turned around and reversed from there and hit that stop for 668. So it's either a winner if you took profits there, got out, or a loser if you were holding out for T2. Depends on how you traded it. And the loser would be down about, 6.5% or so from entry, somewhere around there. So I'll post an update on this. Where do I think it goes from here? These ag commodities just can't seem to catch a bid lately. I'm not as warm to them as I was recently, only because of the price action. They're just, these divergences playing out for little pops, but then they make lower lows. it's still diverging, and it's probably going to have a sharp reversal soon. I'll have to look at the futures charts, which I haven't done today. But you can see here, if we go any lower, or even at this point, we're already starting to form some bullish divergence. So look for a reversal here anytime soon, a bullish candlestick or anything like that, especially if we keep these positive divergences intact, and that could set the stage for a rally that takes us up to that previous first target and maybe all the way up here to that second target there. So as of now, it's stopped out, so it's no longer an official trade. And again, I'll post an update on that, remove it on the home page as I always do, and move that into the completed trade categories. And then last is Verizon. They already reported on April 24th, so we're out of earnings are out of the way there. You have, nothing's changed since we shorted it here on the back test of this, or on this at this downtrend line with this trend line just above. So the bigger picture, if you're new to this one, it's still an objective short entry in my opinion. You have a big bearish rising wedge on the weekly chart here, just like we had a bearish rising wedge here. Negative divergence at the highs, and boom, that was our correction there from peak to trough, 25%. This one had one wave down. There was about a 22% drop, which seems to be just the first of, probably what'll be a multi-wave, move down. And that's it. So we shorted that one relatively, and especially in price recently, right around this same level. And so we're about flat on that, wherever we shorted that. I don't know the exact entry, but there it is. Okay, we'll wrap it up here. I'm actually kind of excited to see how things go the next couple days here as earnings come out. All along I've been waiting for this, figuring that would be the next shoe to drop. As I said, to me at least, I'm not gonna try to downplay coronavirus, because there's certainly a possibility to get another wave, resurgence of cases, or something. Maybe it comes down the line of flu season. But to me right now, it's more so about earnings than corona. I think there's been part of the tail end of this rally recently, I think, where people have picked up is the optimism, seeing all the peaks, and the curves going down. The curves are peaking. States are already lifting or planning to lift restrictions. And so I think that's making everybody feel good, and I hope so. But again, I'm of a different mindset than the stock market is, or the masses are right now. I think the bigger risk to I shouldn't say the bigger risk, but a very real risk to the market is a reality check on not just what happened to companies last quarter, more so what's going forward. Supply chain disruptions, the fact that at best the economy is going to come back online as a soft boot, not a hard reboot. It's going to take a while for everything to get back online, firing on all cylinders again, and so therefore that will, I believe, be the catalyst for the next leg down. And so we'll see. Like, again, this week being peak earnings week should give us some clues by the end of the week. Let's see where we're at. All right, we'll wrap it up here and pick it up tomorrow. This has been Randy Finney with Right Side of the Chart. Have a great evening.